Way2 Limited plans to require its outstanding bond. The interest rates are prevailing in the market have dropped significantly from the time the bond was issued 10 years ago. Way2 Limited intends to know if it is advantageous on its part to retire the bond and issue a new bond. The following information was provided for the outstanding bond. Number one, the amount, we have 10 million. The remaining life is 20 years. Number three, the coupon rate 9% per annum. Number four, call price 105 shillings. The par value is 100 shillings. Number five, an amortized bond issue cost 150,000. Number six, an amortized bond discount 500,000 shillings. Number seven, corporate rate 30%. Number eight, overlapping interest period is 1 month. The new bond to be issued, one, the amount is 10 million shillings. Number two, the tenor is 20 years. Number three, the corporate rate 8% per annum. Number four, bond issue cost 350,000 shillings. Required, advise Way2 Limited on the required initial cash outlay, 5 marks. Part 2, which says, determine the annual cash savings, if any, from the old and new bond. Now, annual cash flow savings, is it cash flow savings? Yes, annual cash savings. Annual cash savings will be equal to the annual cash from old bond minus annual cash from the new bond. The difference will be the annual cash savings. Annual cash flow from the old bond minus the annual cash flow from the new bond. So this will give us the answer. So we are going to have a working here. Workings. Let's begin with the annual cash flow from the old bond. Annual cash flows from the old bond. We begin with the interest. Interest is what percent? The old bond, the interest is 9% of 10 million. Interest is 9% times 10 million, which is equal to 900,000. Then we are going to deduct the tax savings. Less tax savings. Before we apply the tax to get the tax savings, we need to identify which amounts are available for tax savings. The first one being interest. The first one is interest of 900. Then we add the amortization of discount amortization. And we are talking about annual. The total discount for the old bond, the discount for the old bond is the total discount, the unamortized discount is 500,000. So we have 500,000. We are going to divide by 10, which will be equal to, this will be equal to 50,000. 50,000 is the amortization of discount. Then we have amortization of bond issue costs. Amortization of bond issue costs. That is amortization. amortization of bond issue costs, we know the total bond issue cost from the old bond, unamortized bond issue cost is 150,000. 150,000. So we are going to divide 150,000 by 10. That will be equal to 15,000. So we are going to get this total of 965. This is the amount that is available for tax saving. So we apply the tax. So the tax saving is equal to 30% times the 965 times 30%. So the tax saving is 289.5. This we deduct from the interest, minus 900,000. This is equal to 610,000.5. Right? 610,500 is the annual cash flow from the old bond. 610,500. Do you understand? Let us move on to calculate the annual cash flow from the new bond, the annual cash flow from the new bond, new bond, annual cash flow savings from the new bond. We begin with the interest. The interest rate is 8%. The amount is still the new bond. The amount is 10 million. 10 million. 8% of 10 million is 800,000. 800,000. Then we deduct the tax saving. Tax saving. The tax saving. The amount that is available for tax saving. Interest. This interest, 800. We then add the amortization of bond issue costs. The amortization of bond issue costs, we have the bond issue cost 350. Amortization of bond issue costs, that is amortization. Amortization of bond issue costs. The total bond issue cost is 350,000. 350,000. This is the total. The 350,000 is the total. This 350. We are going to divide this 350 by the tenor. The tenor there is 20 years. Divide this by 20. So you have 350. 17.5. 17,500. 17,500. Then we get that total. 17,500 plus 800,000. This is equal to 817.5. Then the tax saving, 30% times 817.5, right? Times 0.3. So the tax saving is 245,250. So this we are going to deduct from 800,000 to get 554.75. That is the annual cash flow from the new bond. 554,750. So the annual cash savings will be the difference. That is, this is equal to 55,750. 55,750 is the annual cash savings. That is question Roman number 2.